We now reached the final part of deep dive series on HDFC Bank, one of India's largest private sector bank and now one of the most important stock for serious investors to understand. But before that, make sure you subscribe the channel and like the video. Don't forget to subscribe the channel. Thank you. In part 1, we ask whether a great business automatically becomes great investment. In part 2, we ask whether lower growth can still create wealth if valuation and profitability improves. Now we come to the most dangerous question of all. Is HDFC Bank undervalued today or is it simply cheaper for a reason? This difference can decide whether you build wealth or trap capital for years. Because many investors make an expensive mistake. They see a stock below old high, below old premium valuation or moving slowly and instantly call it cheap. But cheap price and cheap value are not the same thing. Serious investors do not buy discount, they buy mispricing. First principle, a stock can look cheaper because growth slowed, returns on capital weaken, industry conditions change, expectation reset, or better alternative emerge. In that case, lower valuation may be justified. So before calling any stock undervalued, ask one brutal question. What exactly should improve from here? Is there no catalyst? Or low valuation alone may not save you. Now apply this to HDFC Bank. For years, the market awarded premium valuation because investors trusted five strength: consistent loan growth, strong deposit, superior margin, clean asset quality, and reliable compounding. When a business repeatedly delivers, the market pays a premium. But when growth moderates and profitability compress, market reassess. That is not fear, that is mathematics. For banks, valuation is often judged through price to book, price to earnings, expected ROE, and growth assumptions. But the most useful practical question is simpler. Is today's price assumption too little future improvement? That is where opportunity lives. If the market is overly pessimistic and fundamentals recover, return can be powerful. If the market is correct, the stock may remain average. So what must improve for HDFC to re-rate? First, loan growth must strengthen. If advances remain weak, earnings compounding may stay moderate. But if growth moves towards stronger double digit, sentiment can shift before annual reports fully show. Second, margin matters more than many realize. Even a 20 to 30 basis point improvement in net interest margin can be powerful at scale because that benefits spread across a giant earning asset base. Third, return on equity must strengthen. A bank that converts shareholders' capital into profit more efficiently often receives better valuation multiple. Fourth, deposit quality matters, not just deposit growth. Any bank can chase deposits. The better question is whether deposits are granular, sticky, and lower cost. Fifth, confidence must return. Market do not price only numbers, they do price confidence in future number. If investor believe post merger reset is ending, re-rating can begin. But what if none of this happens? Then lower valuation may be justified. And this is where discipline matters. If growth remains moderate, margin stay compressed, and ROE stays average, the stock may remain respectable but not exceptional. That distinction is critical. Respectable company, average return potential. Now, microeconomics. Even the best bank operates inside the economy. Investors should watch credit demand, RBI liquidity, interest rate cycle, deposit competition, consumer borrowing appetite, and corporate capex. If macro improves, execution becomes easier. If macro weakens, even strong franchisee face headwinds. So valuation is never only company specific, it is macro sensitive. Now the real investor decision. Do not ask only is HDFC Bank cheaper than before. Ask is future growth underestimated? Is profitability likely to improve? Is the balance sheet transition ending? Is management entering a cleaner growth phase? Is there better risk reward elsewhere? That is portfolio thinking. My direct view is very simple. HDFC Bank can become attractive when pessimism becomes higher than actual risk. That is when quality franchisee often creates opportunity. But if investors buy only because the name is famous or because price looks lower than before, that is weak analysis. The opportunity is not in brand, the opportunity is in the gap between perception and future reality. And remember this very carefully. Wealth is not created by buying known greatness at any price. It is created by identifying improving reality before the crowd fully prices it in. Having no position is also a position. Waiting for clarity is also a strategy. Discipline is also compounding. If you want more deep analysis where we think like investor, not fans, subscribe now. Thank you very much. See you in the next video. Thank you.